Welcome everyone to the next in our series of the Markets Masterclass. Today I'm joined by Luke Roberts. He is head of our commodity sales at Lloyd's. Welcome, Luke. I'm Alex Price. I work in the sales team within LBCM at Lloyd's as well. And thanks for taking the time to come with us today and to share your thoughts with us. I know sitting close to you in the dealing room that the last 18 months or 2 years in the commodity space have been very interesting and very volatile. So it's really good to do our first Markets Masterclass on commodities, and really looking forward to you sharing your experience on how clients should think about their risks and some of the challenges that our clients face. And without further ado, it would be great if you could just share a little bit of your experience on how we can help clients and how clients should prioritize their risks around some of the commodity products and risks that they face.
That's great. Thanks, Alex. Great to be here. Thanks everyone for joining today. I suppose starting off from a more holistic point of view, here at Lloyds Bank, we help people across FX rates and commodity hedging. And the first thing to say is that really we've seen a real emergence or re-emergence of different risk factors across each of these spaces. So, obviously on the FX side, the impact of GBP USD on cash flows is always going to be very very key. And so if you look at the matrix below, you'll see how corporates are continually looking at additional actions, in changing their kind of risk management strategies to look at this, because the impact of this is quite severe. Where we've seen the real changes has been in the rates and the commodity space. So obviously, when we think about interest rates, after 10 years of benign rates that have not done very much, we've now seen kind of rapidly increasing levels. And so that's meant that corporates have gone from a place where they're just, happy to sit and watch, what rates have been doing. The current approach was sufficient, and the impact of a few basis points moves might have been unpleasant. Suddenly that's changed. So we're now seeing and have seen, lots of additional actions taking place on the rate side, as that potential impact has gone to medium, which could have a significant impact. On the commodity side, similar. In previous years, corporates could have been forgiven for just kind of watching commodity prices or passing those through to their end clients if possible. But because of the volatility that we've seen over the last 18 months, 2 years, that has shifted the potential impact on commodity price moves from slightly unpleasant to suddenly quite problematic when we look at some of the price moves that we've seen up to 10 times, 12 times the price when we think of some energy indices. So as a whole, here at Lloyd's, keen to support people across FX rates and commodities, but really pleased to get a chance to speak about commodities today, which is my area of expertise.
Yeah, no, thanks. I think what we have seen obviously is that a number of client sectors that traditionally haven't really been focused that much on their commodity risk have been a lot more focused on that, as we've seen these big price spikes and lots more volatility around many different commodity spaces, particularly in the energy space. So just in terms of your experience, which sectors do you think are becoming more vulnerable, and where were the areas that you really touch on in terms of some of our clients and client sectors that are really kind of bringing to bear around some of these price spikes and volatility in the energy market that we have seen?
Yeah, great. I suppose the first thing to say is that here at Lloyd's, we've been helping clients to manage their commodity price risk for over 15 years now. And the basic definition of a commodity is that it's a tangible good that can be bought, sold, or exchanged for products of similar value. And obviously, is a key part of a key input cost into many of our clients' businesses. Generally, they're categorized, in different areas as kind of energy, metal, or agricultural products. And we've got a full suite of, a full suite here that's able to help clients to manage across all of those different areas. When we think about sectors that have been, significantly impacted, the obvious ones spring to mind when you think about transport, producers, and some kind of industrial sectors. But really, we've seen lots of other sectors start to look at this in more detail, just because it has risen up the priority list, so much. So when we think about retail, we think about, food, fashion, wholesale, grocery, even hospitality, where there's a large retail footprint, or lots of premises, commercial real estate, etc. Historically, the margins were large enough to kind of handle some of these kind of price increases, but the way that we've seen a synchronized kind of price inflation across the different commodities means that actually they've started to look at this in more detail. Utilities, again, and probably more unusual, I suppose, technology and even business services. So when you think about, energy consumption, data centers, etc., again, new industries that are starting to look at their commodity exposure in more detail and have come to us and asked us to help in this area.
Yeah, I guess that's been a big area of change in delving into some of those other sectors and assisting clients that traditionally wouldn't have featured all that heavily. But I guess it's been given the market volatility that we've seen since before COVID, and where we've seen the market risk really ramping up quite a bit since the onset of COVID. And obviously bringing to bear the Russia-Ukraine war and all of the changes around that. Where do you see the kind of spike risks that we have seen in which kind of sectors, and where do you see that going forward? Where do you think the risks really lie for some of our clients over the next couple of years, as those the ramifications of what's happened over the last couple of years really get brought to bear?
Yeah, I mean, one of the first things to say is that the UK is quite exposed to commodity price risk in general. We're net short in terms of our position on lots of these commodities. So we're kind of purchasing these in an international market, which is moved by kind of global macro factors. And even though when we think of ourselves here in the UK, we think that we're the kind of the center of the universe sometimes. Actually, that's not the case when it comes to some of these kind of commodity markets. So we're buying on the spot market, and so we're having to fight for our share here. And even when we do produce our own commodities, thinking of the likes of natural gas, actually, because of the interconnected relationship with Europe, because of pipelines and interconnectors on the electricity side, we have to respond to the price action that we see in Europe. And we don't have some of those levers that some of the other countries have. So the US has its strategic petroleum reserve. They can pull that lever. Europe has its gas storage that can supply gas for 3 months, and here we have 3 days worth of gas storage. And so as a country, we are quite exposed to commodity price risk, and we're now seeing that kind of come to bear in the price action that we've seen over recent years. I suppose a whistle-stop tour through some of that price action. When you look at the slide in front of us, I think the first thing to note is just how synchronized some of these price moves have been across energy, power, gas, diesel, Brent, and some of the base metals here, like aluminium and copper. We can see from the lows of COVID, in that 2020 period, to March 22, we've seen everything kind of rise, as a result of the COVID bounce back, potential, China reopening, was a key driver for some of the base metals, and And yeah, I suppose kind of dollar strength as well, has been a key figure when we look at aluminium, kind of the weakness kind of rising up to the peak, and then obviously the strength, afterwards, which has forced prices to come back down again.
Yeah.
But the key driver, as you mentioned, kind of, Russia, Ukraine, we've started to see how kind of Russia's position across, so many commodity markets has just meant that, we've seen those price spikes across the energy and the metals. And I haven't included the slide here, but also on the agri side with wheat prices, with Ukraine again being the one of the bread baskets of Europe, and just the impact that we've seen there. So yeah, that's where prices have been. That's where they went to, obviously, in the kind of height of the crisis. Prices do look better now than they used to.
Yeah. Do you think we're starting to set a bit of a base now? And, do you think there's a kind of an opportunity for people to get back in and reset a little bit? Or what do you think going forward in terms of some of the potential risks and spikes that might come along?
Yeah, absolutely. I think, when we think about Europe, we had to replace, on the natural gas side, we had 155 billion cubic meters of, Russian supply into Europe that suddenly had to be, found elsewhere, which is why we saw those price spikes. To some extent, obviously, LNG cargoes, were extremely helpful coming in from the US, Qatar, Australia as well. So that did help. Norway and the UK continental shelf to an extent, has also started to fill in some gaps there. We've started to see an increase in renewable generation, but again, increased renewable energy has only really covered about 10% of the previous kind of Russian energy supply into Europe. So there's still a long way to go there. But obviously, a warm winter and then a pretty benign summer period has helped prices to come down, and as we've seen kind of gas storage levels into Europe, some of the panic, I suppose, has come out of the market, and as you said, it looks like we have been kind of basing around here, which is still 2 to 3 times higher than where prices were pre-crisis. So it's still quite a high base, but I think, looking forward, we would say that risks are certainly to the upside. All it would take is, a cold winter or, China, Asia, bidding, on the international kind of LNG market to drive supplies, from the US, over to Asia. Something like that. We saw recently kind of strike action in Australia that could have had the potential there to to reduce LNG production. So I think moving forward, and we've got to remember that industrial demand has been muted over this time as a result of these high prices, and it's considered that maybe 10% of European industrial production might never come back, because it's been mothballed for so long. So and where we land in terms of the recession moving forward, if some of that industrial demand does start to come back, then I think we will see prices increasing. So I can't advise on timings for hedges and things like that, but certainly we do see some upside risks across the different commodity markets. When we think about oil and diesel, we know that there's supply bottlenecks. Saudi Arabia with their kind of 1 million barrels a day reduction till the end of the year is keeping prices elevated. And then longer term, when we think about metals, we think about the transition, the energy transition, and how that call on copper, for example, is already a well-used industrial metal, but the amount of copper that's going to be required as part of the energy transition sees, moving forward, prices certainly going to increase. So it does seem that now as part of the kind of robust risk management policy, now could be an opportune time if we do see any dips in particular to start to look at those hedges.
Just revisit your hedge book, yeah.
Absolutely.
Okay. Oh, well, that's great. Thank you for the whirlwind tour. That's very helpful. We will be taking questions at the end. I forgot to mention. So if you do have any questions, please put them in the chat, and we'll be going through some of those at the end. But clearly, Luke, from what you've said, obviously, and Lloyd's are particularly uniquely placed to help clients with their commodity risk management. What would be useful is if you could just, highlight some of the bank's capabilities and which specific commodities we do cover, and just maybe an example of a typical trade that we see clients doing in the current market. That would be really useful.
Yeah, I mean, what our clients generally are looking for is, someone who can help them to, potentially quantify, what their commodity exposure is. There might be, a third-party distribution contract with an embedded fuel price escalator that they want to look at, because that exposes them to a changing commodity price. Could be an indirect exposure, or it could just be a standard input cost, whether that's energy, metals, or agri products. And so, firstly, we want to kind of stand alongside our clients and to help them, and to look at peer analysis, correlation analysis, back testing, whatever it might be, to support them in their journey towards managing some of these commodity risks. And we've got other teams in the bank as well that will help us. Obviously, we've got a great FX team with the FX and commodity risk often coming hand in hand. Can help on the FX side, but then also financial risk advisory, who can look at the kind of hedge policy decisions, and can actually help to create a new hedge policy that includes commodities, and accounting advisory and things like that. Because obviously one of the first questions people often have is around the hedge accounting for commodities using financial derivatives. So again, more than happy to bring the full kind of length and breadth of the bank to support clients in those discussions. But in terms of what products we offer, generally, financial swaps and option strategies across those three categories of commodities that I mentioned earlier: energy, metals, agri. And it's a good product suite across oil, UK electricity. We've seen kind of huge demand on the UK electricity side, as you would imagine, with prices. The refined oil products there, your jet fuel, but also your kind of diesel, petrol, fuel oil. And then natural gas, again, that's been another kind of key area that our desk has been helping clients with. And then carbon emissions, that's a new product that we started offering last year. So that's helping our clients to manage the regulatory exposure to both the UK ETS and the EU ETS, and the ability there to buy spot and forward on those commodity, those carbon markets, has been just lost the lights there for a second. So that's been a new product for us. But then also on the kind of the metals LME product suite there, some precious metals, and then the wheat, corn, coffee, cocoa, sugar, the oil seeds on the agri side, is a way that we can help clients. And then to think of a typical trade, I suppose I think of a UK power swap. So this has been a key transaction that we've done over the last few years. So this is where a corporate can look at buying a fixed amount of energy for a fixed period of time at a fixed price, and it's unrelated to the supply agreement. So Lloyd's is never going to turn up with some electricity or barrels of oil or anything like that. These are all cash settled derivatives. And so what a client would do is they would purchase their electricity on a floating basis, referencing the N2EX day ahead index, for example, and then you could put a commodity swap over the top of that. And this is really key, if you've got a contract maturity coming in a year, 2 years, but actually you want to maintain that hedge horizon beyond the end of the contract to protect from a sudden increase in pricing. That's where a commodity swap, such as a power swap here, would come in useful. And on what it does is it will smooth out some of that volatility that we see. So you can see in the chart there, a client can set a price at £95 per megawatt hour, and then that will smooth out the monthly volatility that we see in the market. And so just briefly, the green bars in the above chart show the price where the company pays their supplier for the physical power on a floating basis, tracking the index. And then very simply, where the day-ahead average is higher than the fixed price, Lloyds Bank will pay the company the difference. And when the day-ahead average is lower than the fixed price, the company will pay Lloyds Bank the difference. So there's a monthly settlement as we go through the life of the trade. And the net effect there is that the company achieves a set price of £95 per megawatt hour for all months, irrespective of the day-ahead average price. And that's just a quick example, but again, more than happy to go through specific examples if anyone's got anything in mind. We can kind of, as I said, run correlation analysis, back testing, and even benchmarking as well. So that gives clients peace of mind that when they see prices coming in from the supplier, if they've got a financial price alongside it, it gives peace of mind there, and maybe the additional flexibility of a financial swap can sometimes beat that supplier price as well. So it's good to bear that in mind.
Excellent. Well, I think maybe our building management might need to do a little bit of power hedging, given the lights went off in the middle of the presentation, but maybe we can have a chat with them afterwards. But thanks very much, Luke. Just in terms of some of the conclusions before we go to questions, what would you like clients to take away from the call, and what would your messages be around how things get they should think about their risk going forward?
Yeah, I think from my point of view, the fact that we do have a commodity hedging desk here is first and foremost good to know, put faces to names, and with the volatility that we've seen, it's great to know that we are one of the few kind of UK banks that does offer commodity hedging, and we're here to help, whether that's kind of reviewing risk management strategies or looking at energy in particular, which is often left unhedged or just managed with those physical supply contracts, which as we've seen come to an end, are quite hard to negotiate, and do leave companies exposed to that price jump risk.
Yeah.
And yeah, just to think about the financial products that are on offer, which kind of do help to hedge longer tenors, offer additional flexibility, and remove the reliance on suppliers' credit rating, which, as we've seen in recent years, with some suppliers leaving the market, going bust, or suffering reputational damage.
Yeah.
You have a bank here that's able to help in all of these areas.
Well, that's super helpful. And just one last thing, I think before we started the call, we were catching up, and I think that you promised to give us your top 10 tips for managing commodity risk, to help our clients think about what they should be thinking about in the current market with the volatility. So what do you have in mind?
Yeah, so very, very quickly, first thing would be check indirect exposures. So whether these are in third-party contracts or in finished products that you buy, check what the commodity component is, because that could be a hidden risk. Secondly, don't fix and forget. It's very tempting to sign up to a contract for 3 years and then forget about it for 2.5 years. But actually, there's ways of proactively managing that price jump risk, as we've seen by layering in derivatives. Separate the counterparty credit risk between hedge and supply. There's no need to have all our eggs in one basket with supply and fixed prices with utility companies. We can bifurcate or separate those risks and have a financial institution with good credit rating to help with the fixed price or the hedge. Increased dialogue between Treasury and procurement. This goes without saying, and I'm sure many companies are doing this with the prices that we've seen. But procurement might not know, that banks offer these kind of products. So it's good to keep everyone kind of looped up and in the picture. Protect working capital. So that's about, using banks' credit line to, forward purchase, commodities and using derivatives. You keep cash as king in the business, and you don't have to pay until delivery by hedging forward. Incorporate commodity risk into your hedge policy. Often FX and rates are very well covered, but if you incorporate commodity risk, it takes some of the emotion out of choosing when to hedge, and some of the regret possibly, thinking that you've hedged at the wrong time. But actually, if you follow a policy, it takes that emotion out, and you kind of average in, as the hedge policy dictates. And lean on your bank. So, there's commodity desks such as mine, and we've also got those financial risk advisory teams that will help people to look at these things, and often for free, unlike a paid advisor. And again, we can do those benchmarking, back testing, bits of analysis as well to support. Measure the impact of volatility on something like EBITDA rather than percentage turnover. What can sometimes seem a small exposure, actually, when you compare it to kind of the bottom line, can actually be higher than you thought. And it's actually very easy to manage as well. So it could be that there's a quick win there by looking at commodity volatility in more detail. And then don't be put off by hedge accounting. As I said, we've got accounting advisory here. And if there's an economic relationship between the underlying physical prices and the hedging index, then under IFRS 9 UK GAAP, then there is a good chance that that hedge accounting is available. So don't be put off by that. And finally, put yourself in your client's shoes. If we continually pass these commodity price increases on to our customers, how does that impact them if prices keep rising? And if you can offer fixed prices to them, does that help to develop a more sticky relationship with your clients? If you can lock them in for 12 or 24 months, that might be helpful in terms of kind of maintaining those relationships there. So that's a quick whistle-stop top 10 tips.
Very helpful.
But yeah, happy to go through that in more detail with anyone that wants.
Given me some food for thought. So I think that's very helpful. And thank you very much for all of your input and for joining us today. We are going to take some questions. So if you do have anything that you'd like to ask, please pop it in the chat. We'd love to start. I had one just really to start off, which is really about the carbon emission space. I know this is a new piece of business for Lloyd's, venturing into that space. Could you just give us, I think we might like to do a masterclass teaching on this at some stage, but just in terms of where you're operating in that space currently and what's currently possible, I think would be really useful for my guide just to have a brief overview, if you could.
Yes, this is a great new product for us, on the kind of the mandatory carbon emissions side. So separate to voluntary carbon emissions, we're just looking at the kind of compliance markets at the moment, concentrating on the UK ETS and the EU ETS. And we offer clients the ability to buy emission allowances at spot, or to hedge forward by agreeing a fixed price today for some time in the future. So again, talking about that kind of working capital benefit, you can hedge prices today. Where we have seen some weakness, especially on the kind of the UK ETS side. Prices have dropped by almost 70% since the start of this year. And so the ability to hedge forward on that has been really important. So we're mainly kind of dealing with lots of airlines, producer clients, but increasingly seeing kind of manufacturers looking at this as well. And one of the large pieces of work that we've just done is that next year the kind of maritime shipping industry is brought into the EU ETS. So we've been working with clients to with huge exposures in in the Mediterranean, to look at how they can, use hedge strategies to mitigate some of those risks. So spot and forward hedging on carbon emissions, but then also the ability to structure trades. So kind of do a buy and a sell, or a sell and a buy. Some of these kind of time spreads that can help people to move credits that they potentially have on balance sheet, to move them into the future as well. So it's a really exciting space that we're really happy to be in and helping clients.
Yeah, absolutely, and big differentiator. So you're well done on bringing that into the fold. One other thing I just wanted to check, I really liked the hedge example that you gave around the power swap. But when you talk to our clients about swapping some of those power, smoothing it out the impacts, what sort of tenors are people doing? Does it tend to be just short dated, smoothing in some, trying to take out some of those spikes, or do we see people putting in longer dated type of hedging, and what sort of tenors is quite commonplace in that space?
Yeah, so we have the ability to hedge out to 7 years on UK power, which is is quite far, really, considering the the liquidity in the market. Most physical suppliers will only allow hedges out for 2 to 3 years, and that was even reduced to 1 year, in the height of the crisis last year. So we do offer a lot more flexibility in tenor, and what we generally see is clients have a fix with a physical supplier for 2 to 3 years, but as we go through time, obviously that tenor reduces, but they still want to maintain a 2 to 3 year hedge cover, because that's in their policy. That's what they do with FX, for example. So the ability to layer in those power swaps in that second and third year is really key to avoid that price jump risk, as we've mentioned.
So there is some advantage in pushing out the tenor a little bit, do you think? Maybe?
Oh, absolutely. So we do see a lot in that second to third year space, but then again in that third to fourth year space, again, where clients are generally not going to get that physical supplier cover. Is kind of where we do see a sweet spot, for managing that risk. But again, if prices do come off and clients want to look at longer dated hedging, especially where power is a really key input cost. It can be for some of our kind of manufacturing utility clients, it can be very very high proportion of their cost base. So to lock in longer dated pricing there might be suitable.
And you're also obviously reducing that supplier risk with where you have the hedge with the same supplier. So
exactly,
that can be kind of very useful as well.
Yeah.
Excellent. Well, thank you so much for your time. I don't think there are any further questions, but that was really useful today. I found that very helpful. And hopefully we can get you back, and love to hear a little bit more about the carbon space as that area develops, because that seems to be an area that's particularly hot at the moment. But yeah, thank you to all our valued clients for joining us, and I don't know if you had any last words.
No, thank you so much for having me. I suppose if you want to keep in touch, please do reach out. Our contact details are on the screen. We do produce weekly updates across energy, looking at diesel and oil in particular, and then also gas, power and carbon emissions. So if you do want a regular market update, please let us know and we can add to those distribution lists. And we're always thinking about adding new products as well. So we're thinking about adding steel products, and also biofuels, and transition metals as well, thinking of platinum, palladium, cobalt, lithium, things like that. So it's a really growing,
exciting space.
So yeah, please do watch this space.
Fantastic. Thanks to everyone for joining us today.
Thank you.
Cheers. Bye.